So having wrapped up our objective investing series where we looked at things on a very macro high level view, we're going to switch gears a little bit this week and take a look at something from the bottom up, if you will, in an asset class that's often overlooked but can provide a lot of value to investors of all types. One of my favorite quotes is that boredom is a fear of self. So while that could certainly be interpreted in a lot of different ways, what does it mean for today's topic, which is municipal bonds of all things? So don't shut off the camera or the video right away. What am I talking about here? Well, building wealth, maintaining wealth, most of the time is a pretty boring process. That's why people don't want to engage in it. That's why they're constantly trying to seek out other get-rich-quick schemes, i.e. Bitcoin. As relates to the second part of that quote, a fear of self, again, when you're going about building wealth the right way and maybe engaging in things and processes that might be quote-unquote boring, what you have to realize is that, again, a lot of those impediments are within us. Impatience, not being disciplined, again, falling prey to those twin evils in terms of investing, in terms of greed and fear. And so what happens when you're doing that, and again, if you don't take that time to really be patient, to understand that this is going to take time, is you're going to skip over an asset class like municipal bonds that can be really attractive, again, to helping both build and maintain wealth. What is a municipal bond? Really quickly, it's states and other localities that issue debt to people that is tax-free. It can be tax-free both in terms of state income taxes, if you live within the state of issuance and you have a state income tax there, and they're all free of federal income tax. So again, while it's always great to get a return, you need to look at what is that net return after tax. And for municipals, obviously with their tax-free nature, some of what might just appear on the surface is actually enhanced if you take that into effect. What are three quick benefits of municipal bonds and maybe three dangers or realities that people should be aware of? Well, if you think back to our objective investing series, we talked about why are you holding this thing? And again, when it comes to bonds, there's really three things that you hope to get. Perhaps to a lesser extent, a total return. They're not going to keep up with something like a stock over time, but still can be beneficial. And if you look at municipal bonds, particularly high yield municipal bonds, over the last 15 years, they've averaged about a 2% better annualized return than most high quality corporates and treasury bonds. So that's pretty good. If you look at an income stream, particularly in today's low income world, on, again, a tax equivalent yield, so you factor in that tax-free nature, where treasuries are about a 3%, a lot of corporate bonds are at about a 3%. The tax equivalent on high-yield munis is close to 8%. So that can be, again, really beneficial to achieving that second objective for investors, getting a high income stream. Thirdly, and for those people who might be saying to themselves, I'm more of a growth investor, why the heck would I want to hold any municipal bonds? They're a great diversifier. If you look at how they act, again, diversification to us is not just owning a bunch of different things, but owning things that don't act the same under the same conditions. In investing speak, that means they have a low correlation to one another. I'll show you a quick chart here. I'm going to get Matt to zoom in on, again, that just looks at the S&P 500 up here on one end of the spectrum, and down here, the Barclays Aggregate Bond Index. And this is a 20-year chart, and you can see here high-yield municipal bonds not only fall right in the middle between the two, but they have an extremely low correlation with respect to either one. What does that mean, and what's the real benefit of that? Well, the beginning of this year gave us a great example of how this can help investors of all sorts who might be invested in the asset class. This year, high-quality bonds and stocks correlated at the same time. Traditionally, they have been invested into diversify, but the problem is both of them were afraid at the time and sold off as a consequence, and continue to be hesitant about rising interest rates and what that might mean to both those asset classes. With a really low correlation, not that high-yield municipal bonds can't have their own struggles at a given point in time, really shown through, again, in the first 6 months of this year. Stocks were essentially flat, most fixed income was negative, and high-yield municipal bonds posted a really strong positive return over that time frame. So for those investors who are more conservative, it certainly helped buffer their volatility. For those people who might be invested in them as a diversifier but still with a growth objective, they could have sold off those municipal bonds at that time, having made a little bit of money, to go buy some things that might have gotten beat up. So again, this is how we think through municipal bonds. They're not right for everyone, but they can certainly be beneficial to a lot of investors. That being said, there are some dangers. Matt just chastised me a moment ago in the first cut of this, in case you're thinking this is one take, that I got really deep in the woods and made this super confusing. Well, if you buy that paper at 105, as it slowly gets close to its maturity, i.e. the date at which point someone will be paid back, that premium is going to come out and you're going to lose money. And so you might get to collect that coupon for a while, but it's going to erode your principal over time. So I'm going to try to make it a little simpler. Simply put, a lot of the people who used to try to rate these papers, which is another way of saying evaluated their risk of the person, the municipality not paying you back, or companies that tried to insure the paper, i.e. they would step in case of a default and pay you, after the 2008 crisis have gone away, and or a lot of people don't see the value in getting ratings. What does that mean for you, an investor? Well, two things. One, there's more danger out in the marketplace as a consequence, in the sense that you don't necessarily know what you're getting. There's been, in case of a non-rated piece of municipal bond paper, no real way to evaluate what you might have. On the other hand, there's some great opportunities. When you talk to the managers that we work with, they're excited about this new reality, because it gives them a chance to really flex their muscle, use their deep bench of resources and expertise to go out and find hidden gems within the portfolio. But if you're out trying to buy individual municipal bond paper, or you're working with a local broker who's just buying things off of a terminal, you're running a lot of risks, both of picking up something that may not be beneficial, and consequently you might be also missing out on some great opportunities. Finally, just the cost, again, of individual municipal paper is something we see. A lot of portfolios come in where they've got a long list of individual municipal bonds. I think people really underestimate the cost of trading those. Really simply, as you might have caught on, institutions don't want to deal with little clients. They don't want to deal with little trades. And when they have to deal with it, they jack their fees up. It's why we really, for all the aforementioned reasons, but this is another one, love to use institutional money managers to be able to not only get their expertise, but also to be able to invest alongside of them to get the better cost on these trades that they can get. How does the market look today? Well, real quick, supply is really low. That's good and beneficial. Our managers tell us they're finding great opportunities within the space. And with the new tax reform, or capping a lot of the deductions for state and local taxes, there's still a real hunger, even though rates have come down, tax rates, in terms of high net worth buyers. So lack of supply, still really solid demand, can make for good long-term entry points. With that, we hope you found this helpful. Again, taken from that high level down to the micro level of thinking through objective investing and how to make good considerations for your portfolio. Thanks so much.